talk about a fascinating puzzle that just happened in the world of finance. We're diving into the airport operator Fraport and their recent Q3 results. Because the real story here wasn't in the headlines. It was buried deep, deep in the numbers. So, picture this. On November 10th, Fraport comes out with this announcement that's, well, it's a mixed bag. Some good news, some not so great news. But the stock market's reaction, it was anything but mixed. It was, frankly, explosive. So what on earth did investors see that most people missed? That's the puzzle we're going to solve today. And when I say explosive, I really mean it. The stock shot up over 10% in a single day, hitting a 6-year high. I mean, this wasn't just a little bump. This was a massive vote of confidence from the market. The big question is, why? Okay, so to really get to the bottom of this, we first have to break down this apparent contradiction, the thing that made Fraport's announcement so puzzling in the first place. It's like a tale of two reports. On one hand, you've got everything an investor dreams of. Profits are surging. Earnings absolutely crushed what analysts were expecting, and they had record cash flow. But then you look at the other side, and you see these clear red flags. They trimmed their passenger forecast, their home market in Germany is lagging, and they're dealing with high costs. So how do you make sense of that? Let's start with the easy part, the good news that everybody saw right away, the massive, headline-grabbing profits. The number that really jumped off the page was their EBITDA. That's basically a measure of pure operational profit, which hit a whopping 593 million euros. Now, analysts were expecting 533 million. So Fraport didn't just beat expectations, they blew them out of the water. That's a 23% jump from last year. Just huge. So how'd they do it? Well, a super strong summer for travel definitely helped, and that pushed their revenue up 8%. But, and this is the key, there was a secret ingredient here, a one-time 50 million euro refund from their pension plan. Now that's a nice little bonus, but it's a one-and-done deal. You can't count on that happening again. And all of that good news trickled down to the bottom line. Their net profit for the quarter was up an incredible 26%, hitting 343 million euros. By any measure, it was just a fantastic quarter for profits. But here's the twist, and this is the most important part of this whole story. As great as those profit numbers were, they weren't the real reason the stock went on that incredible run. The smart money, the serious investors, they were looking at something much, much deeper, a fundamental shift in the company's DNA. So if it wasn't the headline profits, what was it? What was the real story? Well, the thing that truly got the market excited was all about two simple words, cash flow. Now, free cash flow can sound a little technical, but the idea is actually super simple. Think about your own paycheck. After you pay your rent, your groceries, your car payment, and everything else, the money that's left over in your bank account, that's your free cash flow. It's the real, actual cash a business has left to grow, pay down debt, or give back to its owners. It's the ultimate sign of financial strength. And this is the number that changed everything. In just 3 months, Fraport generated a record-breaking 373 million euros in free cash flow. To give you some perspective, in the same quarter last year, that number was just 135 million. This wasn't just a small step up. It was a giant leap, a total transformation. And this right here explains why that cash flow number matters so much. You see, for years, Fraport has been what you'd call an investment phase. Think of it like a farmer planting seeds. They were spending billions and billions on these huge projects, like a new terminal in Lima, Peru, and the massive new Terminal 3 in Frankfurt. But now those projects are finishing up. The company is entering the harvest phase. The heavy spending is finally ending, and the cash is starting to pour in. And this wasn't just a one-quarter fluke. This was a major, major turning point. It was the first time since 2018, the first time in over 5 years, that the company's cash flow for the first 9 months of the year was actually positive. For investors, this was like a giant neon sign flashing. The long, expensive years of building are over. The era of reaping the rewards has officially begun. Okay, so the cash flow story is amazing. But what about that bad news? The part where they trimmed their passenger forecast? Well, this is where you have to understand that Fraport is really operating in two completely different markets. The reason for that little forecast cut was very specific. It wasn't a global problem, it was a local one. It's something analysts have started calling the German lag. The aviation market in Germany is just recovering a lot more slowly than in other places.
You can see the difference so clearly here. The main hub in Frankfurt is still only back to about 90% of its pre-pandemic traffic, kind of held back by high taxes and fees. But then look at their international airports. Places like Greece, Brazil, and Turkey are absolutely booming. They're already back at 2019 levels. This shows their strategy of not putting all their eggs in one basket is really, really paying off.
And you don't even have to take my word for it. The company's own leadership spelled it out for everyone. This quote from them directly connects the end of those big building projects to the immediate positive impact on free cash flow. That is the exact message investors were desperate to hear. So, let's put it all together. What does this mean for Fraport's future? It means that this harvest phase we've been talking about is truly just getting started. The path forward looks incredibly clear. This year, 2025, the peak spending finally ends. Next year, that huge new Terminal 3 opens in Frankfurt, which is going to bring in a whole new flood of revenue. And after that, spending on new projects stabilizes, which frees up a ton of cash to do two things: pay down debt and reward shareholders. So here's the bottom line. The market looked right past the minor negative headline because it saw the much bigger, much more important story underneath. Investors understood that Fraport was transforming itself from a company that spends cash to build things into a company that generates cash from the things it has built. It's basically going from being a construction company to being a cash machine, and that signals a much stronger, more profitable future. And that leaves us with one final big question. In an industry that is famous for these massive, eye-wateringly expensive projects, Fraport's pivot to a harvest phase, focused purely on generating cash, is a really powerful move. It makes you wonder, is this intense focus on cash flow, and not just passenger numbers, the new blueprint for success for airports all around the world? Definitely something to think about.